All right, welcome to The Explainer. Today we are diving into a really radical idea, one that connects Darwinian evolution, the quirks of the human brain, and the chaos of the stock market. We're going to get into the wisdom of crowds, the madness of mobs, and this wild concept of evolution happening at the speed of thought.
Okay, let's just jump right into this with a pretty incredible puzzle from history. So January 28, 1986, the Space Shuttle Challenger tragically explodes just 73 seconds into its flight. Now, the official investigation, that would take months and months to figure out what went wrong. But the stock market? Well, it seemed to have the answer in a matter of minutes.
So check this out. While all four of the main contractors saw their stocks dip, the market immediately singled out one company, Morton Thiokol. They're the ones who made the solid rocket boosters. Trading on their stock was literally halted just 13 minutes after the explosion because of how intensely people were selling. By the end of that day, it was down to staggering 12%. Why? Because the market somehow had already figured out that the faulty O-rings made by Morton Thiokol were the culprit months before any official report came out.
This incredible phenomenon, this wisdom of crowds, is actually the foundation of a really powerful, and for a very long time, a totally dominant theory about how markets work. It basically suggests the market is something close to all-knowing.
Yeah, it's called the efficient markets hypothesis, or you'll hear it called EMH. And the core idea is pretty simple. The market is like a giant, super-fast information processor. Every single piece of news, every rumor, every bit of analysis gets instantly baked into an asset's price. The takeaway? The price is always right, which means trying to beat the market is pretty much a fool's errand, because how could you possibly know something that the entire collective doesn't already know?
Now, this idea didn't just pop up overnight. It all started way back in 1900 with the random walk theory. You know, the idea that price movements are as unpredictable as a drunk person's walk. Then it got some serious mathematical muscle from Nobel laureate Paul Samuelson. And then you fast forward to the 60s, and a guy named Eugene Fama uses the first big computers to find what looked like definitive proof. And he's the one who gave the theory its famous name.
Okay, but hold on. If markets are so perfectly rational, so smart, then how do we explain things like bubbles and crashes? Why do they sometimes feel completely, totally insane? Well, the problem, it turns out, lies in the theory's biggest assumption, the one it makes about us, the humans who actually make up the market. You see, the EMH is built on this idea of a creature called Homo economicus. You can think of it like a perfectly rational robot from a sci-fi movie. But you and I? We're Homo sapiens. We're messy, we're emotional, we're driven by these ancient instincts like fear and greed. We use mental shortcuts to get by, and we make predictable mistakes, like the fact that we hate losing money way, way more than we enjoy making it.
$7.2 billion. That is the loss that's attributed to a single trader, Jerome Kerviel. His story is just a classic, textbook example of loss aversion. He tried to hide a small loss, then he panicked and doubled down again and again and again in this irrational spiral. His actions just go to show how one emotional mistake can snowball into a multi-billion-dollar catastrophe. But where does this kind of irrational panic even come from?
So here's the really interesting part. Our irrationality, it's not a bug, it's a feature. It's actually deeply hardwired into a brain that was designed for a world that looks nothing like Wall Street.
Think about it. Our brains are basically running software that was designed for escaping predators on the savannah. We have this little part of our brain called the amygdala. It's like our neural fire alarm, and it gives us the gift of fear, letting us react to a threat before we're even consciously aware of it. But in the modern world, those same instincts can be totally counterproductive. Like a pilot's gut instinct during a stall is to pull up on the stick, which is exactly the wrong move. And on the flip side, the rush you get from a big financial win, it can trigger the same reward centers in your brain as a drug like cocaine, creating this really dangerous feedback loop of more and more risk-taking. So this brings us to a huge paradox, right? If we as humans are so flawed, so predictably irrational, how can the market, which is just a bunch of us, be so incredibly smart sometimes, like with the Challenger disaster? Well, the answer requires a whole new theory, one that blends economics with the principles of evolutionary biology. And this is where a brilliant new idea comes into play, the adaptive markets hypothesis, or AMH for short. It argues that markets aren't like these perfect static machines. No, they're more like a jungle, a dynamic, evolving ecosystem, where the very same forces that shape life here on Earth
Competition, variation, natural selection are what's driving financial behavior.
Okay, so to really get this, let's do a quick refresher on how evolution works. It's pretty simple, really. First, you need variation. Different individuals, different strategies. Second, you need selection. The environment has to favor certain variations over others. And finally, you need reproduction, where the successful strategies get copied and spread.
All right, let's try a little thought experiment to see this in action. I want you to imagine a species, and their success depends entirely on the weather. In any given year, it's sunny 75% of the time, and it's rainy 25% of the time. But the key is, the pattern is totally random and unpredictable.
And boom, this is where it gets really interesting, and it illustrates the whole idea. One group, we'll call them the optimizers, tries to be perfectly rational. They always bet on the most likely outcome, sun. The other group, the adapters, uses a simpler rule of thumb. They match the odds, betting on sun 75% of the time and rain 25% of the time. Now look what happens. After 10 generations, the supposedly irrational adapters are the ones who thrive and dominate. So why does this happen? Well, the optimizers, they do great when it's sunny, but in a rainy year, they risk getting completely wiped out. The adapters, on the other hand, they hedge their bets. They guarantee their survival, and in the long run, they don't just survive, they win the whole evolutionary race.
Okay, so what does all this mean for our own financial world? Well, looking at it through this new evolutionary lens, it changes pretty much everything.
Here's the big takeaway. It's not about being rational or irrational anymore. That's the wrong way to look at it. The real question is about being adapted or maladapted. A strategy that looks like reckless greed in one moment might be perfectly adapted to a raging bull market. And a behavior that looks like crippling fear could be the absolute key to survival during a market crash. The question is never about rationality. It's about how well your strategy fits the environment you're in right now. And once you start thinking this way, you see the whole financial world as this amazing, complex ecosystem. You've got different species filling different roles. You have your hedge funds. They're the predators, hunting for special opportunities. You've got passive index funds. They're like the big herbivores, just grazing steadily. High-frequency traders? They're the scavengers, profiting from tiny little scraps left behind. Regulators try to be the park rangers, keeping things from getting too out of control. And all of us, the investors, we collectively form the changing environment that all these other species have to adapt to.
And all of this leaves us with one last, really big thought. If finance isn't a perfect, predictable machine, but a wild, evolving ecosystem, then stability isn't guaranteed. It has to be actively managed. And that raises a really critical question. If this is just another one of nature's ecosystems, who's supposed to be the park ranger here? Who is responsible for making sure this powerful force of nature actually serves humanity, and not the other way around?